Welcome back to XRP On Moon, the channel where we break down the biggest, most explosive developments in the XRP ecosystem, cutting through noise and delivering clarity that actually matters to investors. Today's update is not just another headline, it's a signal, a pressure point, and potentially a turning moment. Because right now, behind the scenes, a major financial firm is reportedly pushing back hard against the SEC over delays tied to a potential XRP ETF. And this isn't just routine frustration. This is starting to look like a direct challenge to regulatory authority. The question is, why now, and what does this mean for XRP holders? Let's get straight into it because this situation is building fast. Over the past few years, the idea of an XRP ETF has gone from being almost unthinkable to now sitting right on the edge of reality. With Bitcoin ETFs already approved and Ethereum ETFs entering serious discussion phases, XRP is no longer a fringe contender. It's part of the conversation, but here's where things get interesting. While other assets seem to be moving forward, XRP continues to face delays, hesitation, and what some are now calling selective regulatory resistance. And now a firm whose identity is becoming a major talking point in financial circles is reportedly threatening legal escalation if the SEC continues to stall. That's a big move. In traditional finance, you don't casually challenge a regulator like the SEC unless you believe you have leverage, legal standing, or a very strong case. This signals confidence. It suggests that the firm believes XRP's legal clarity, especially following key court developments, is strong enough to justify ETF consideration without further delay. But let's break down why this matters so much. An ETF, or exchange-traded fund, isn't just another product, it's a gateway. It opens the doors for institutional capital to flow in at scale. Pension funds, hedge funds, asset managers, these entities often cannot directly hold crypto assets, but they can invest through regulated instruments like ETFs. So when you talk about an XRP ETF, you're not just talking about price speculation, you're talking about accessibility, legitimacy, and massive liquidity potential. Now imagine this, a firm is not only applying for such a product, but is now willing to confront regulators publicly. That shifts the narrative. It changes XRP from being seen as a maybe later asset into something that institutions are actively fighting to access. And markets react to that kind of shift. Not always immediately, but structurally. Another layer to this situation is timing. Why is this happening now? The broader crypto market is entering a phase where regulatory clarity is becoming the deciding factor for growth. XRP, due to its long-standing legal battle, actually has more defined positioning in certain areas than many other cryptocurrencies. Ironically, the very lawsuit that once held XRP back might now be the thing that propels it forward because clarity, even if hard-earned, is still clarity. What we're seeing is pressure building from multiple sides. On one side, institutions want access. On the other, regulators are cautious, possibly hesitant to set a precedent that could open the floodgates for other altcoin ETFs. And in the middle of all this is XRP, an asset that has survived legal scrutiny, maintained global partnerships, and continues to be one of the most discussed digital assets in terms of real-world utility. Now, here's the key point most people are missing. This isn't just about one ETF application. This is about positioning. If one firm succeeds in pushing XRP into the ETF space, it creates a domino effect. Other firms will follow. Competition will increase, exposure will expand. And suddenly XRP is no longer just a crypto asset. It becomes a mainstream financial instrument. But of course, none of this happens without resistance. The SEC's cautious stance may be driven by more than just XRP itself. It could be about control, precedent, or broader concerns about how quickly the crypto market is integrating into traditional finance. And that's exactly why this threat from the firm is so significant. It introduces urgency into a process that has been anything but fast. So where does this leave us right now? At a crossroads. A moment where pressure, opportunity, and uncertainty are all colliding. And for XRP holders, this is the kind of setup that often comes before major shifts. Not guaranteed outcomes, but high-impact developments that can reshape the narrative very quickly. Because make no mistake, when institutions start pushing back this aggressively, it's usually because they see something coming. And the real question you should be asking is not whether XRP will react, but how big that reaction could be if this situation escalates further. The situation around the XRP ETF delay is starting to evolve into something far more intense than a simple regulatory back and forth. What initially looked like standard procedural hesitation from the SEC is now being interpreted by major market participants as a deeper structural conflict between institutional demand and regulatory pace. The core issue is no longer just whether an XRP ETF will be approved, But how long traditional regulators can realistically hold back growing institutional pressure without facing open resistance from financial firms that have already positioned themselves for entry? The firm at the center of this developing tension is reportedly taking a firm legal stance, suggesting that continued delays are no longer acceptable under current market conditions. This is not a casual complaint. In financial regulation, escalation of this nature usually indicates that internal confidence is extremely high. It suggests that the firm believes the legal framework around XRP has already reached a level of clarity that should allow for ETF progression without further unnecessary obstruction. That belief is significant because it implies that the argument is no longer about uncertainty, but about interpretation. At the same time, the SEC's position appears to remain cautious, possibly driven by broader concerns about setting precedents for altcoin-based ETFs. XRP is not being evaluated in isolation. Every decision made here could influence how future crypto assets are treated in regulated financial products. This creates a balancing act where approval of one ETF could open the door to many others, increasing market exposure, but also regulatory complexity. That is why delays from the regulator's perspective may be seen as risk management rather than resistance. However, the market interpretation is different. Investors and institutions are beginning to view these delays as friction against inevitable adoption. XRP, in particular, sits in a unique category because of its partial legal clarity following court decisions that distinguished it from other digital assets in important ways. This has strengthened the argument that XRP should not be treated under the same uncertainty framework as purely speculative tokens. As a result, pressure from financial firms is not just about profit potential, but about regulatory consistency. What makes this moment more critical is the shift in tone from passive waiting to active confrontation. When firms begin to challenge regulatory timelines, it signals a transition in market maturity. It means that crypto is no longer being treated as an experimental asset class, but as an emerging financial infrastructure where delays can directly impact institutional strategy. This creates urgency not only for the firm involved, but also for others watching closely from the sidelines. There is also a broader market psychology at play. Every delay increases anticipation, but it also increases frustration. The longer the ETF approval process remains unresolved, the more it amplifies speculation about what approval could unlock. This tension often builds into volatility, not because of fundamentals changing overnight, but because expectations accumulate faster than decisions are made. XRP sits directly in the center of this dynamic right now. If this pressure continues to build, the SEC may eventually face a situation where maintaining delays becomes more costly in terms of market perception than proceeding with a decision. That tipping point is what institutions are likely anticipating. The firm's aggressive stance may be an attempt to accelerate that timeline by introducing legal and public pressure simultaneously. For XRP holders, this phase represents a critical observation window. The direction of this conflict will likely influence not just ETF outcomes, but also broader institutional sentiment toward XRP in the coming months. The market is no longer reacting to isolated news points. It is reacting to the buildup of structural momentum underneath regulatory resistance, and that momentum is starting to become harder to ignore. The growing pressure around the XRP ETF delay is now beginning to expose a deeper layer of institutional frustration that has been building quietly for some time. What is unfolding is not an isolated disagreement between a single firm and the SEC, but rather a reflection of a broader shift in how traditional financial players are interacting with crypto regulation. The tone is changing from passive submission to active insistence, and XRP is becoming one of the central battlegrounds where this transition is playing out. At the heart of this development is the perception that XRP has already crossed a threshold of legal and market maturity that should place it in the same category as other assets that have seen ETF progression. Institutions are increasingly viewing XRP through a utility and compliance lens rather than a speculative one. This distinction is important because it directly influences how aggressively they are willing to pursue regulatory approval. When an asset is seen as structurally important to financial infrastructure, delays are no longer viewed as routine, they are viewed as barriers to capital efficiency. The firm reportedly challenging the SEC appears to be operating from this exact perspective. The underlying message is not simply impatience, but a belief that the regulatory framework is lagging behind market reality. In other words, the market is moving faster than the rules designed to govern it. This creates friction, and XRP is currently positioned at the center of that friction. The firm's stance suggests that it is prepared to escalate if necessary, which introduces a new level of seriousness into what might otherwise have remained a standard approval process. Meanwhile, the SEC's cautious approach continues to reflect its broader mandate of risk control and precedent management. Approving an XRP ETF is not just about XRP itself, but about what it signals to the rest of the crypto market. If XRP receives approval under certain conditions, it could establish a legal pathway for other digital assets to follow. This makes every decision more consequential, and it explains why timelines often stretch longer than market participants expect. From a regulatory standpoint, delay can be seen as a method of maintaining control in a rapidly evolving environment. However, the challenge with prolonged delay is that it does not occur in a vacuum. Market expectations continue to evolve while regulatory decisions remain pending. This creates a widening gap between what institutions believe should happen and what is actually being executed. Over time, that gap transforms into pressure. And when enough pressure accumulates, it begins to manifest in more direct forms, such as legal threats, public criticism, or coordinated lobbying efforts. XRP's position in this scenario is particularly unique because it already carries a partial regulatory narrative from previous legal rulings. Unlike many other crypto assets, XRP is not operating in complete uncertainty. That partial clarity strengthens the argument from institutional players who believe it should be treated as eligible for advanced financial products like ETFs. This is why the current dispute feels less like a question of if and more like a question of when, with the timing becoming the primary point of contention. Another important factor is the market signaling effect. Every time a major firm pushes back against regulatory delay, it sends a message to other institutions watching from the sidelines. It signals that the cost of waiting may be higher than the risk of challenging the system. This can create a ripple effect where more players begin to align on the same expectation, that XRP's integration into regulated financial products is not speculative, but inevitable. At the same time, the broader crypto market is entering a phase where regulatory decisions are becoming catalysts rather than barriers. Instead of suppressing momentum, regulatory outcomes are now acting as triggers for capital movement. In this environment, XRP is highly sensitive to any shift in ETF-related developments. Even the perception of progress or resistance can influence positioning across institutional portfolios. What makes this moment particularly significant is that both sides appear to be entrenched in their positions. Institutions are pushing for acceleration while regulators are prioritizing caution. This creates a structural standoff where neither side is willing to fully concede. In such scenarios, resolution often comes not through gradual compromise, but through a defining decision point that forces clarity. For XRP, that decision point may be approaching faster than expected. The combination of legal confidence from institutions, increasing public pressure, and growing market anticipation is creating conditions where the status quo becomes harder to maintain. Whether that leads to approval, rejection, or further delay, the impact will likely be substantial because the market is already positioned for movement, not stagnation. The tension surrounding the XRP ETF delay is now shifting from isolated institutional frustration into a broader narrative about regulatory adaptability in a rapidly evolving financial system. What is becoming increasingly clear is that this is no longer just about one application or one firm's objections. It is about how long existing regulatory structures can maintain control over a market that is already functioning at institutional scale in certain areas. XRP sits directly in that intersection where legacy regulation meets modern digital finance, and that collision is beginning to produce visible pressure. The firm reportedly challenging the SEC is effectively acting as a catalyst in this environment. Its stance represents a growing sentiment among institutional players that time itself has become a critical factor in crypto adoption. In traditional markets, timing determines competitive advantage. When regulatory delays begin to interfere with that timing, firms start to push back more aggressively. The language of delay begins to transform into obstruction from the perspective of capital allocators who are trying to position ahead of market cycles. This is where XRP becomes particularly important. Unlike many digital assets that are still trying to prove real-world utility, XRP already has an established narrative around cross-border payments, liquidity solutions, and financial infrastructure integration. That utility narrative strengthens the argument for ETF inclusion because it reframes XRP not as a speculative token, but as an exposure vehicle to a functioning financial network. This distinction is critical in how institutions justify regulatory pressure. At the same time, the SEC remains locked into a framework that prioritizes caution over speed. From a regulatory standpoint, every ETF approval is not just a product decision, but a structural precedent. If XRP is approved under certain conditions, it will inevitably influence how future crypto ETFs are evaluated. This creates a domino effect that regulators are fully aware of, which explains why decisions are often slow and heavily scrutinized. The intent is not necessarily resistance, but controlled progression. However, the market is no longer operating at the same pace as the regulatory framework. Institutional demand for crypto exposure has accelerated significantly, and ETF structures are now seen as essential bridges between traditional finance and digital assets. This creates a mismatch between demand velocity and approval velocity. XRP is currently one of the clearest examples of this mismatch, where market readiness appears to be outpacing regulatory confirmation. The escalation from the firm is significant because it signals that patience thresholds are being reached. In financial systems, escalation is rarely emotional. It is strategic. When a firm begins to challenge regulatory timelines, it usually indicates that internal models have already priced in a high probability of approval, or at least eventual acceptance. The challenge is not about speculation, but about acceleration of a process they believe is already justified by market conditions. This dynamic introduces a new layer of complexity into the XRP narrative. It is no longer just about price speculation or legal clarity in isolation. It is about the pace at which traditional financial systems can absorb decentralized assets into regulated structures. XRP is effectively being used as a test case for that absorption process, whether intentionally or not. As this situation develops, the broader market is watching closely because ETF approvals have historically acted as major liquidity triggers. Bitcoin's ETF developments already demonstrated how powerful institutional access can be when properly structured. And the expectation is that XRP, if approved, could unlock a similar or even more targeted wave of institutional positioning due to its utility-driven profile. But the current friction suggests that the path will not be entirely smooth. Regulatory hesitation combined with institutional pressure creates a volatile equilibrium where progress can feel sudden but is often preceded by long periods of buildup. XRP is currently in that buildup phase, where pressure accumulates beneath the surface until a decisive shift occurs. What makes this phase particularly important is that both sides are now highly aware of the stakes. Regulators understand that delaying too long may increase market frustration, while institutions understand that pushing too aggressively could harden resistance. This creates a strategic balancing act where neither side wants to appear reactive, yet both are actively influencing the outcome. For XRP, this places the asset in a uniquely sensitive position. It is not just reacting to market sentiment anymore, it is embedded in a larger negotiation between capital markets and regulatory authority. The outcome of this negotiation will likely shape not just ETF approval timelines, but also how future digital assets are categorized, evaluated, and integrated into mainstream financial systems. XRP ETF situation is beginning to look less like a routine regulatory delay and more like a structural confrontation between institutional demand and regulatory control. What has built up over the previous phases is now reaching a point where the consequences of continued hesitation are becoming just as significant as the consequences of approval. The firm's reported threat against the SEC is not simply an isolated act of frustration, but a signal that the patience window in traditional finance is narrowing, especially when it comes to high-demand digital assets like XRP. At this point, the XRP ETF narrative has evolved into something much larger than a single product approval. It has become a representation of how quickly traditional financial systems can adapt to the realities of tokenized liquidity and blockchain-based infrastructure. XRP, due to its established use case in cross-border settlement and financial messaging networks, is uniquely positioned in this discussion. That positioning is what makes the ETF debate more sensitive, because approval would not just validate a product, it would validate a broader financial integration model. The SEC's continued caution reflects a deeper institutional responsibility. Regulatory bodies are not only assessing XRP in isolation, but also evaluating how its approval could reshape the entire crypto ETF landscape. Each decision carries precedent weight. If XRP is approved too quickly or without strict conditions, it could accelerate a wave of similar applications across other digital assets, increasing market complexity and oversight challenges. This is why delays, from a regulatory perspective, are often framed as necessary caution rather than obstruction. However, the market does not interpret time in the same way. For institutions, time is capital efficiency. Every delay represents opportunity cost, especially in a market where positioning ahead of major structural approvals can define long-term returns. This is why the tone from financial firms has shifted from passive waiting to active pressure. The reported threat of escalation is a reflection of that shift, indicating that institutional actors are no longer content to wait indefinitely for regulatory alignment. XRP sits at the center of this tension because it has already crossed multiple thresholds that many other assets are still trying to reach. Legal clarity in key jurisdictions, ongoing financial partnerships, and established use cases give it a profile that institutions find difficult to ignore. This is what strengthens the argument for ETF inclusion. From their perspective, XRP is not a speculative experiment. It is a functional asset that already operates within global financial workflows. As pressure continues to build, the dynamic between regulators and institutions is becoming more visible. This is not a silent negotiation anymore. It is a gradual exposure of differing timelines, priorities, and expectations. On one side, regulators are focused on controlled integration and risk mitigation. On the other side, institutions are focused on speed, access, and competitive positioning. XRP has effectively become the intersection where these two timelines collide. What makes this moment particularly important is the potential for a tipping point. In financial history, prolonged delays in high-demand approvals often lead to sudden resolution events rather than gradual conclusions. Once pressure reaches a certain threshold, decisions tend to accelerate quickly because maintaining uncertainty becomes more costly than resolving it. XRP appears to be approaching that threshold, where continued delay may no longer be the most stable option for any party involved. For XRP holders and market observers, this phase represents a critical transition point. The outcome of this ETF situation will likely influence more than just short-term price movement. It will help define how digital assets are integrated into regulated financial products moving forward. Whether the resolution comes through approval, structured compromise, or further delay, the impact will be significant because the market is already positioned for a shift in status, not continuation of uncertainty. From a broader perspective, this entire situation reflects a maturing financial ecosystem where digital assets are no longer operating on the fringes of traditional markets. Instead, they are increasingly embedded within institutional strategies, regulatory frameworks, and global capital flows. XRP's ETF debate is simply one of the clearest expressions of that transition. This content is for informational and educational purposes only and does not constitute financial advice, investment advice, or trading advice. Cryptocurrency markets are highly volatile and risky. Always conduct your own research and consult with a licensed financial advisor before making any investment decisions.